Hey guys, today I want to walk through a retirement distribution strategy. So what I have here is a software I utilize for clients, and typically when I'm utilizing the software, this could be on a year-to-year basis, but sometimes it's forward projecting. So meaning the year that we're projecting doesn't exist yet. So what I'd like to do with this video is really talk through the different sources of retirement income that you have and how that affects your cash flow and taxation. As always, in all the videos that I do, this is just for education. It's not personal tax advice, personal financial advice, or investment advice. So I hope this is helpful, and I want to start with a couple concepts. So I'll orient you here. This is basically assuming that this is the year 2025. And basically, I can fill in all of the information here about a client. This person is married, filing jointly. This is someone who is retired, so they're 65 and older. So I've checked those boxes. And really, what I can provide here is sources of income. And when you retire, there's really going to be three major buckets of money that you are drawing from. And it's either going to be money that is either qualified, such as IRA withdrawals, 401k withdrawals, or again, tax deferred is a broader term. So you could include things like pension distributions, et cetera. And you can see these categories here. I have IRA distributions, taxable pensions and annuities. Those would be in the tax deferred bucket. And then you're going to have what would be taxable. So that would be sometimes referred to as brokerage, or it could be individual stocks. It's either going to be qualified dividends or it's going to be non-qualified dividends. So we have a section here, qualified dividends, and that's going to be in a taxable account and distributed accordingly. And we have long-term capital gains and short-term capital gains. That's the second bucket. The third is going to be Roth. And notice there's a section here for Roth conversion. That's for another video, but it's not going to show up here. And here's why. This is whatever is on here has some sort of tax implication. So think of the Roth distribution as phantom. It doesn't show up here. So you could distribute however much you want from your Roth, and it's not going to show up in these columns, because the purpose of these columns is to figure out how much of my income is actually taxable so that I can figure out my tax liability, and therefore my cash flow can be improved. So as I've met with clients, I've really realized this is a really good value add on a yearly basis, because a lot of times, especially retirees or those approaching retirement, don't exactly understand how all of these income sources are going to add up to a tax liability and how they can control that. Now, you have control to the extent that you have diversification in your income sources. So if I looked on this column and all I saw were IRA distributions, well, we don't really have a lot of levers to pull, meaning all we can really do is set a withholding rate throughout the year for federal and state and make sure that it is as close to zero at the end of the year as possible. Now, if we have a taxable account, we have qualified dividends and long-term capital gains, and we have a Roth account, and we have an IRA account, then in that case, we really have a lot of flexibility here. So what I want to show you is that you can create income in retirement if you have a diversified stream of income, meaning it's not just coming from one type of account, that can really be very impactful for your cash flow, so that you can do the things you want to do more throughout the year. And potentially you can actually live on less, but it feels like you're living on more because you keep more of what you actually distribute. So I want to walk you through here. So in this case, we have qualified dividends. So this is assuming we're pulling 10,000 a year from a taxable account, and those are all qualified. So in that case, just as a brief overview here, qualified would mean you get dividends from owning a stock over a long period of time. I'm not going to go into the nitty-gritty details here in this video, but basically why you want them to be qualified and non-qualified is because qualified dividends are taxed at more favorable rates. And we'll go over that in a second. We have an IRA distribution, so they're taking 11,600 out per year. This is for a couple, and this is saying that their combined Social Security is 62,000. I'm going to go into this in a lot of detail in a second, But recognize, even though the gross amount of Social Security that they actually have that feeds onto their tax return, they're actually only taxed on only 21,810 of that is actually taxable. So working our way down here, we also have $10,000 in long-term capital gains. Now, for our purposes, an additional 10,000 to the qualified dividends are taxed in the same way, but it's just another amount of income that they have coming in here. So just kind of doing some quick math here, we have 62,000 plus 10, that's 72,000. And then we have 82,000 with our qualified dividends. Now, remember what I said in the background. I'd like for you to consider that this is almost like a $100,000 gross distribution and how that might be taxed. So even though we just added up to 82, remember what I said about the Roth. So let's just assume there's another 18,000 a year in Roth, but remember that's subject to no tax. So we have $100,000 essentially. So what I want to show you is um, notice the total taxable income is much lower. It's 53 because we take away the 18,000 from Roth. Remember, even though we have a lot of Social Security coming in, because we are distributing in a efficient way, only 21,000 of that is subject to tax. So that number is essentially 21,008 plus 10 plus 10. And that's how we get our total income. So we're adding that plus our 11,600. So basically, just to recap again, 21,800 from Social Security, 11,600 from IRA, 10,000 here, and 10,000 here. That's how we get this number. Now that becomes our adjusted gross income, but guess what? We're over 65. And because of that, you have a pretty large standard deduction. Now, right now, that is set at 33,200. So their taxable income total, what's actually taxable is 20,000. But what's interesting here is because of the way that the taxes work between pulling from tax deferred and Roth and capital gains, they are in the 0% capital gains bracket. That's why this total tax number is so low. And so you may be looking at this and say, so again, I want to show you they essentially have zero tax liabilities, the point of this video. And so basically, even though it's showing $21, again, we could make that zero very easily. And so the reason is because anyone who has a taxable income below a certain threshold for 2025, it's much higher than this. Married filing jointly, it's going to be in the 90s. I believe I'm not exact, but ballpark, it's going to be in the mid 90s in terms of thousands of dollars. So if your taxable income is that, all those capital gains that are being distributed are actually distributed at 0%. So in addition to your Roth money being distributed at 0% because it's not subject to tax, your capital gains are actually subject to zero tax. So now you're up to a very large amount. And then if you think about taxable Social Security, essentially you're adding that Social Security to your IRA distributions, and then you subtract the standard deduction, leaving you zero tax liability. So this is really powerful, and I really want you to understand how this works. In order to show you this, I think the best way for me to demonstrate this is to actually play with some of these numbers so you can see. So what I'd like you to see is, okay, this is kind of a fictitious $100,000 scenario. What if it's slightly lower? Maybe it's 80. It's only going to improve, but it only improves to the extent that you have the right buckets turned on at the right time. So for example, I want to show you the drastic difference here. Let's say that you didn't diversify retirement and basically you didn't have any taxable money. So you never really filled that up. And so you don't have any of that non-qualified money or taxable money. There's not really any capital gains that you're distributing in retirement. I want you to see how that impacts your distribution strategy and how year over year, what that would do to your taxes. So nothing else has changed. Okay, basically, we're just living off of Social Security. We're living off a small IRA, and we're also living off of some Roth money. That's in this scenario, okay? So if we just scroll down here, the reason we have no tax is because we are only living off of essentially Social Security. So let's just take that other money that we were going to use for capital gains and let's just put it here. So essentially, we're going to have to add, this is going to have to become 31.6 because we're adding $20,000. So if I add this, okay, now realize here's kind of where we're at. So this Social Security, we're adding these two. Our standard deduction is not going to be able to take care of that. Okay, so we have some tax liability. Now this is only going to get more complicated depending on what our other distribution sources are. So say you also have a pension. So again, you're really heavily tax deferred. So you have IRA distributions about 30,000. Let's say you have a pension every year that's $20,000. Okay, so we added a pension. Notice what happened to Social Security. So really, another point of this video is how you distribute income in retirement is actually going to drag up or down how much of your Social Security is actually taxed. Okay, so in this case, it went from 21 to 38 because you have more tax deferred money that you are drawing in to your distribution strategy. So again, just by making that small change, you more than tripled your tax liability. Now, is this high? Is this a high tax liability? Absolutely not. $6,000 for most people over the course of a year is very manageable. But what I'm trying to tell you is $6,000 to $0 from a cash flow perspective, that's several $100s that you didn't have before. So just being smart year after year about how you're actually drawing down and how your distribution strategy plays in to how your taxes are affected or not affected. I found that in meeting with clients, this can actually be really helpful. And sometimes we can optimize where they thought they didn't really have many options. So hope that's helpful. That's really the purpose of this video. And I'd like to do another one to discuss, again, some of the other things in this software that I utilize with clients. But this is just one small example of how things can change drastically in the event that you distribute differently. Now, before I end this video, I want to show you one final example. Okay. And this is basically this is going to be a heavy Roth example. Okay. So let's just make this a little lower. Let's say 15,000. Actually, let's make it 20,000 for an IRA distribution. Okay. So they're going to distribute 20,000. Let's take away the pension in this case. Okay. So there's no pension. So no pension. And then basically what I want to show you is there's a lot less Social Security being taxed here. But to the extent that I add or subtract pension, this is where something like a Roth tax-free distribution really helps you, because you might have another 30 or 40,000. If you're able to really get more Roth dollars in your plan earlier, they can grow more and you can distribute them more, meaning you're more tax efficient when you get to retirement. So in this case, let's just say that you're able to pull 30,000 a year from Roth because you have the ability to do that with a sustainable withdrawal rate. If that's the case, then basically this 20,000, you're going to add another 30, that's 50,000. Then you're going to have a gross Social Security of 62 coming in. There's going to be some withheld there for taxes and Medicare. But in this case, really the thing we're trying to control for is what is that tax withholding, right? Medicare, you can't control in terms of every year you have to pay that premium, probably out of the Social Security. But let's just make that, an even 50. So we got 50 plus 30 for Roth plus 20. I mean, before you know it, that's 100, right? So this is just another way to pay no tax. So again, the reason you pay no tax there is because, again, just to kind of walk you through this IRA distribution is subject to your ordinary income rates. But since your Social Security is only taxed according to other forms of income that you have in retirement. In this case, the majority of what you're actually distributing is not even on this column, it's Roth. So basically, the way this 11,000 is calculated is basically half of that Social Security number, and this is called provisional income. It's how they calculate it. Half of this Social Security number plus that other rate. There is a set schedule. Again, I think it's beyond the scope of this video to go through the exact way that that's calculated. But basically, you have only 11,950 of taxable income. You're adding that to the IRA distribution. And so when you get here, this pretty much nets out exactly what is your standard deduction. Well, 31,950 minus standard deduction equals, it's easily zero. So you have no tax liability. Therefore, even the Social Security that you are getting, you don't need to withhold any tax from it. You would just pay Medicare out of it. So you're keeping more of that 62,000, which actually makes your day-to-day, month-to-month, year-to-year retirement just seem so much better because you're keeping more of what you make. So this is just a little bit of what I do for people that are looking at retirement strategies, pre-retirees, those in retirement year to year wanting to optimize their strategy. So hope it's helpful. And that concludes today's video. And as always, if you want more content like this, please follow along. Brightworks has an Instagram page as well that is a great resource for more educational videos such as this. And I will continue to put educational content. Please like, subscribe this channel, share with people. I want to provide more education to make things as helpful for you, wherever you are in your financial journey. So I will see you next time.